All right, everybody. Welcome to the March edition of the Investing Roundtable. My name is Mark Robertson. I am joined here by Ken Kavula and Cy Lynch. Hi, guys. How you doing tonight?
Doing
Great.
well.
Good stuff. We've got hopefully, I think we'll probably be able to handle the program pretty quickly. Hugh is not able to join us tonight, but the cover slide says it all. We've got two stocks tonight. Ken and Cy have colluded to pick a stock.
No collusion.
No collusion.
No collusion.
Right.
But again,
Independent wisdom.
that's what I heard allegedly, that it was an independent thing again. So we will see. But again, the theme is it never changes. We're always out there looking for excellent companies at a good price. And our definition of excellent companies generally is associated with the concept of up, straight, and parallel, the relationship between the sales or revenue line, top lines in the business model analysis compared to the profitability of the company. Those blue lines are the earnings over time. And again, most of the people in our investing community can look at these and in a heartbeat decide if they want to study a little bit more. I think everybody here tonight would look at either of those two and decide that they are interested enough to continue a study. So we will be presenting those two companies tonight. All right, let me get the legal paperwork out of the way first. No investment recommendation whatsoever is intended. Nothing to be implied by that. This is all about education. It is about the illustration and demonstration of the philosophies, methods, techniques, whatever you want to say about the modern investment club movement when it comes to the analysis of companies and building and maintaining excellent portfolios. We might hold a few companies in our portfolios. We'll definitely let you know if we do, or at least try to. If you'd like to add you or a friend or a family member to the event email reminder list, you can send a quick note to nkavula1@comcast.net. Natalie will not inundate you with email, but she will give you courtesy reminders a couple times a month. If you have questions, follow-up questions, if you're too bashful to ask, or if we run out of time, or if you'd like a copy of the slides or any follow-up, you can send an email to me. That's markr@manifestinvesting.com. All right, I'll just kind of kick things off. Our standing agenda is basically always the same. Again, a big introduction and a big welcome to anybody who might be joining us for the first time. We do try to keep it informal. As Ken was saying in the green room just a few minutes ago, we do monitor questions in the comment tab, and you can raise your hand, and if you have audio, microphone equipment, we can go there also. We do try to run the program about 75 minutes max, so we'll be trying to do that. We'll try to leave questions, time for Q&A at the end. We'll talk a little bit tonight about this notion of our decisions and selections beating the market, the accuracy or performance accuracy that we talk about. Got a couple companies that are close to being worthy of challenge, but probably not qualifying. You'll see that in a minute. Cy, as I said previously, they did collude, and both have selected Charles Schwab to present tonight. I went ahead because we got to at least have a second stock, and went with booking.com. BKNG is the ticker symbol. And as we said, Hugh's not able to join us tonight. All right, we've been doing this now for the better part of 9 years, and it really is a simple format. We try to keep it informal, but we are here to share some of our single best and favorite ideas at this time. We keep track of how we do. We'd like to see the portfolio beat the market by 5 percentage points. We measure the market by the Wilshire 5000 tracking index. And I have modified that bottom goal. We'll show you in a few minutes why we modified the numbers slightly. And we would like to see 50 to 60% of our selections beat the general stock market. So we'll take a look at that. Here is a profile of how we have done on a monthly basis, going back now, as I said, almost 9 years. And again, the average investment club, typical investment club, is attempting to beat the market by 5 percentage points. That is the line that is across here. So our return, our rate of return, actually looking at every single transaction, all the cash flows and everything, is 15.4%. Over that same time frame, the market, as measured by the Wilshire 5000, is at 8.2. So we have beaten it by 7.2. That's the point you see out here on the far right. Almost half of the selections that we've made have beaten the market. And again, this relative return just simply is measuring by how much does the aggregate performance, the composite performance, beat the market over time. And at 7.2, that's in pretty rare, pretty rare company, pretty high up there. And again, if you're in an investment club that is down anywhere towards the bottom of that chart, you're still just keep pressing on, and just realize that it's pretty special to have market beating performance as measured by most stock market conventions. Any thoughts or questions at this point, Ken?
No, I'm just looking at it, and I'm kind of amazed that this is where we're at 9 years into the whole experiment. I know that all four of us kind of kept saying in the beginning, just be patient, just be patient, just be patient. But sometimes it took a lot of patience just to be patient, I'll tell you.
Yeah, there were a few moments that tested that patience, and I'm pleased to say that every single one of the nights and most of the nights and guest nights and guest damsels are all beating the market with their contributions.
Yeah. So. The one thing that jumps out at me outside of the patience lesson is that with the exception of one dot, you don't see anything under the market, which is pretty amazing in and of itself, given that most professionals and most mutual funds, unless you're an index, don't match the market.
Right. Yeah, if we actually included the years 0 through 3, there were some negative points back in the early formative days. We got a bit of a slow start.
Yeah.
All right, let's go ahead and take a look. The actual portfolio, we're not going to spend a lot of time on this. You can actually access the link, whether you're a Manifest Investing subscriber or not, using that public link up at the top. The legend just below it is the number of times any one of those companies has been selected or chosen, either by one of the knights or damsels or the audience. So in the case of Cognizant Technology, it has been chosen 15 times, and you can use every single time that it's selected or a decision is made, $1,000 is invested in it. So $15,000 invested in Cognizant is now worth $25,000. What I find even perhaps a little bit more special, and if Cy had seen this before we started tonight, we probably would have switched from Schwab.
I was just about to say that.
Yeah, you got to keep Cognizant up there. But take note that Microsoft, which is now our largest position in terms of dollars, has actually only been selected 5 times. So that's $5,000 invested is now worth $25,420, which is really kind of cool. Universal Display has shot up, almost doubling in price in the last year to return to the top of this list. And of course, Apple, and then the company that I'm bringing tonight, Booking, holds down the number 5 position. But from top to bottom, you see a lot of household names, some that might be a little less familiar, and we're always interested in discovering exciting, promising, new, smaller companies.
Mark, we're getting a question from Martha, Mark, and she wants to know, how do you calculate the relative return for the entire portfolio? And without going into any great detail, Martha, if you're in a club and if you're using the accounting system, whether it's Bivio accounting or iClub accounting, your club can write a report to come up with relative return and do it in less than 30 seconds. So your club can do it very easily with their accounting software. For an individual, it's a little bit more complicated, but what Mark essentially does is he compares the every single purchase that we make, and that means every single purchase, and he compares it to what the same purchase based on the Wilshire 5000 would give you. he comes up with how much each one of the purchases beats the index, and then there's a function on an Excel spreadsheet called IRR, internal rate of return, and he can do his magic with the spreadsheet and put those all together into a single number. It's not something that can easily be done by an individual, so you'd probably want to get a piece of software. I can recommend the Quant9 software put out by Matt Wilms out of Milwaukee, Wisconsin. Quant9, Quant-IX is how you would Google the name of the company. And the software, it's called Portfolio Manager, I think is the name of the software. And I've been using that software for, I don't know, 12, 15, 18 years. And it calculates all these things with just the push of a button. I wish there was a better answer, Martha, but that's about as good as I can do. Mark, you want to add anything to what I just told her?
No, that's about it for an investment club. It's dirt simple, easy to figure out the performance report. It really isn't a terribly complicated thing with the spreadsheet. Maybe we'll have a worksheet or a workshop one of these days to go through this, because I've been promising a spreadsheet for some period of time. It really is pretty straightforward. You just have to make sure you account for all the cash flows in and out of the portfolio and use that Excel function that Ken talked about.
And you have to be disciplined, and you have to make sure you catch all the dividends on top of that. So
right, we correct for dividends basically continuously. But yeah, it's easier than it sounds. It's ugly when you get into the intimate details, but it works pretty well. Just in a nutshell, our par is pretty good, but it needs to be higher. That's why we're always out there shopping for superior return forecast opportunities. Our quality is just fine at 88.1 that you can see down in the corner. Our growth rate on the overall portfolio is actually, that's a weighted average. These are all weighted averages. At 11% is actually pretty good. We'd like to see that in the 11 to 12% range. And so the portfolio is in pretty good shape. The message is to be vigilant for selling opportunities and certainly be buying companies which will nudge those averages up over the long term.
Mark, George is telling me, Mark, that the name of that software from Quant9 is called Investment Account Manager. Quant9 software, Quant, and then IX for the Roman numeral 9, and the name of the software is Investment Account Manager software. It's a wonderful piece of software. And then John is telling me that he uses XIRR, not IRR. Are you familiar with what he's using, Mark?
Yeah, I think that's what I use too. It's a different flavor
right.
of the rate of return calculation. I will put a link in the forum notes on the program to the Quant9 software.
Great
software. All right. Just for context and just to show you where we've been over the last 14, 15 years, the green shaded areas, the Wilshire 5000, that really nasty V shape at the very end is what happened in the fourth quarter, with things getting real ugly up until Christmas Eve. And we've had a pretty solid bounce back from there. But the net result of that ugly fourth quarter, because fundamentals were actually intact or improving while all the stock prices dove, was that our return forecasts actually went up to multi-year highs. The manifest investing median par, that's basically taking as if you had 2,400 stock studies done, which all had a return forecast and say, what's the average or what's the middle? And it got up as high as 12. It is now kind of scaled back to about 9% as of this evening. So that's a pretty violent whipsaw that we went through here over the last 4 or 5 months. Certainly testing patience and mettle and everything else. But we're back to about 9% for the average stock on a return forecast. All right. In terms of companies that may have performed extremely well, or there's 2 ways to reach this list. The first is to perform extremely well, as in the case of Universal Display, which has nearly doubled in stock price in the last few months. So the projected annual return, the PAR, or the return forecast, has actually reached, mid single digits. And all of these companies have actually done pretty well. So the good stock price performance delivers lower return forecasts. I don't think any of these are anything I would run for the exits. These are all very high quality companies, mid single digit returns. I think I would only become concerned if they approached zero. Would you guys agree with that?
Well, I agree, especially on the first four, Mark. Novo Nordisk has had some issues, starting with the fact that currency makes a big difference in this particular company. This is a Danish company, but I don't know that much about the currency going back and forth between it. But at least the first four I would call good, solid core holdings, and I wouldn't remove them from the portfolio at this point, no.
Okay, and the three at the bottom are the ones that have actually dipped. We try to put any company that lags the market by more than 20% under the microscope. We give a pass to Ardelyx and Hugh's selection of Ardelyx, which he actually first made 4 years ago at a price of almost $11 a share. You can see that it's back up above $3. He's been accumulating that one. As a more speculative opportunity. This is a case of a company that actually not only do they not have earnings, I think there's actually been years where they don't have sales. So it's a pure speculation situation, and we're just kind of giving it a pass and hoping that things will work out. They are attempting to develop, and they're in the late stages of FDA pipeline stuff, with a drug for irritable bowel syndrome and I believe some renal failure type solutions, and
stage renal disease, yeah.
Yeah, and they're expected to get approval or disapproval in I believe it's July, mid-July. So we're just kind of on hold, waiting to see what might happen there. It's the type of thing where we could have a strikeout or a home run. And in the spirit of full disclosure, I have speculated with a couple thousand shares of this one because it did get down to $2 a share not too long ago. All right. On the two healthcare stocks, I'll talk about HIIQ. Again, that's the number one ranked company in the Fortune fastest growing or best small companies, whatever they do for their list. Number one on the list. And the story there is they dropped 7% this afternoon, and then actually went up 6% after hours. So if this was the after hours price, it wouldn't even be here. And so I'm going to recommend that we just kind of wait with health insurance innovations and keep a closer eye on it. But again, it's right at that 20% level. And
well, and in the spirit of our experiment, Mark, I'm going to recommend that we freeze or sell out the healthcare services group holding that's lower than 20%. A healthcare services group got snake bit about a year ago with two large contracts that defaulted. This company does cleaning and food service for healthcare units throughout the country, and it's a pretty straightforward business, but two large clients defaulted on their bills, so that gave them a hit about a year and a half ago. And then most recently they've gotten communication from the SEC asking them to explain how they recognize income, and that caused their stock price to really have some jitters attached to it. And in the spirit of our experiment, we said we were going to move them out when they went over 20 relative return, and this one's over 20 relative return, so I'm going to suggest we move it out. I will keep my eye on it because I own it myself, and if that SEC thing resolves itself, it turns out to be nothing, in other words, then I really like the company. I especially like the dividend that it throws off, and I will add it or bring it back to add to the portfolio again if those things end up being not anything really important.
Okay. So we'll go ahead and sell the HCSG. We'll hang in there for another month and see where we're at with HIIQ. Again, if we were using the current price, not the closing price for today, but the current price, it wouldn't even be on this list. And I'm being a little bit stubborn.
Before we go on, Mark, I just wanted to mention, with connection to the first five, I agree with everything you and Ken said about taken in isolation. None of these look like sells to me based on value. However, even though we are not managing this portfolio as a managed portfolio, our par is about 2, actually closer to 3 percentage points below our goal of my par plus 5%.
Yep.
And so if this were a managed portfolio in the hands of an individual or a club, we should be looking at selling these. Now, in this particular case, the portfolio is so huge that even if we sold these and replaced them with a very high return stock, the total quantity of the holdings wouldn't make that much impact, but we'd still need to be looking elsewhere. But I just kind of want to be clear to anybody looking at the portfolio, if this were a managed portfolio, we would need to be looking at selling these and perhaps others to bring the portfolio par into line.
I'd also like to focus on that growth column. That means sales growth column, and 3 out of the 5 might be candidates in my mind for sales just because of the extremely low sales growth attached to them right now. Yep. I really would like to see our sales growth pushed up just maybe another 0.5%, and the way you do that obviously is to sell slower growing companies. Even though I like all 3 of the companies, they are growing much more slowly than we'd like to see the portfolio growing.
Yeah, and in fact, I read an article about the risks of companies that are growing at less than 5%, and I'll share that. I'll dig it up and share that because it was kind of interesting to look at. A lot of times we think we're in these blue chips that are stalwarts and growing relatively slow, and they keep us safe, and just the opposite is true. They can be very vulnerable to nasty situations. So yeah, I'm with you guys. I like to see that growth number pumped up, and so we will keep pressing on in that regard. The portfolio is down to 80 or so holdings compared to what it was before we began spring cleaning about a year and a half ago. So it is kind of interesting to see. We're getting closer to what I would call a large institutional managed portfolio, or a small institutional managed portfolio of 50, 60, 70 stocks. All right, so let's press on. What I thought I would do is just take just a couple minutes to put this notion of outperforming selections. We refer to it as performance accuracy. We measure the performance, our market beating performance on an incident by incident or case by case basis. What you're looking at here is about 50 years of going back and looking at the long-term track record of stocks and how many of them actually outperform the market over time. And you can see it ranges from a maximum period back in the early 1980s of in the 60 to 70 range down to the high 20s in the worst case, with the average stock over that period of time basically outperforming the market only 43 or 41% of the time. So again, giving some context to this notion of we would like to see 50 to 60% of our selections. That would put us again in this range right here, which historically is pretty good stuff. If we could actually beat, make enough successful selections. And again, it's kind of a two-dimensional thing. The performance accuracy really doesn't matter quite as much as the rate of return, and we're doing just fine on the rate of return. The other thing is it's just common sense that even if you have only 40% of the selections outperforming the market, if they really outperform, like we did a discussion a few months ago where we talked about how you could take the losses from the 30 or 40 worst performers we've ever done, and it would be more than covered by the top 2 or 3 success stories that we have. So again, a lot of the weakness of those weaker performers can be compensated and then some by just a few pretty good selections. Again, there's a link to the article from Ben Carlson from his blog down at the bottom of the page. Any comments or questions about that, guys?
It's a fascinating graph, Mark. First time I've seen it, and I'd like to kind of absorb it. It's really a fascinating set of numbers.
Yeah, and I agree with that.
Yeah, and then there's another graph that isn't on the page right now, but if you went with hot stock tips, the stuff that's showing up on CNBC or at the barbershop or whatever, it would be below this line because basically everything's priced in. So again, just to further give a little bit of context, most of you know we have this stock picking contest that we've been doing now for 13 years at Manifest Investing. We refer to it as the Groundhog Challenge. We keep track of, again, the rate of return statistic and the relative return, but we also keep track of how often do the selections actually outperform the Wilshire 5000. And you can see on this list, this is the leaders over time. You can see that the ones up at the top range from 60 to 70%, and then there's a whole bunch of people that are in the 50s. This is pretty exceptional performance when you compare it against the Motley Fool, cap field of entrants. And notice that many of the knights are on here, guest damsels. Kim is up near the top of the list. A lot of investment clubs that merit here. And again, you start doing this over a 10, 12-year period, like Nick up at the top. That's pretty outstanding performance, again, in the context of the picture that you see here. And again, versus that other field of experience over at the Motley Fool. So again, kudos to everybody. You can see why you recognize many of the names on this list from these sessions and other things that we do in the Better Investing chapters and at Manifest Investing. A lot of fun. John Kimmel out in Kansas is having some good times here. All right, and with that, I think we'll go into our not 3, but 2 stock selections tonight, starting with Charles Schwab. I think we're going to start off with Cy.
I think Cy and I agreed that we were going to reverse the order, if that's okay with you, Mark.
Well, it's not okay with me, but we'll do it anyhow, because it doesn't really matter what I think.
Yeah.
So there we go.
I was going to think backwards, even if you refuse to let us do it backwards, Mark. So.
Do you guys want to go through the slides in the order you submitted them, or backwards?
Yes, in the order we submitted the slides, but I'll go first, then Cy will follow up. Okay.
We could do them randomly like Spotify, just to really mix things up.
Schwab does a really nice job on their website, folks, of giving you quarterly reports on where they think the business has been and where it's headed. I would suggest that if you really want to understand Schwab, that you take a good look at their website. They have a wealth of presentation material that's there, and a lot of it is accompanied by audio. So you can look at the slides, and you can also listen to the audio right along with it. So this is from the most recent presentation about the company, and this is dated sometime in January. So you get the idea that it's very, very new. Next slide, Mark. Schwab is growing, and I think a lot of you think you know what Charles Schwab is. You think that it's a place where you can trade stocks, and you're absolutely right. It's one of the earliest discount brokers, and the cost to trade a stock was $25 in a time era when the average broker was charging $125, and the costs have kind of kept pace, moving down into the single digits as the availability of discount brokers became something everybody had access to, and today there's even the ability to trade for basically nothing on the Charles Schwab platform. But I'd like to read you 3 other things that Charles Schwab does that maybe you didn't know about. First thing is that Schwab, through all of its different subsidiaries and all of its different businesses, supports over $3 trillion of client assets. Now that's a big number to get your arms around. That's $3 trillion of client assets being supported by Charles Schwab. Another thing that you might not know about Charles Schwab is that while it's a relative newcomer to creating ETFs, Charles Schwab is now one of the 10 largest exchange-traded fund companies in the world. So it's grown fantastically in the creation and maintenance of these relatively new vehicles for investment called exchange-traded funds. They basically, in my mind at least, take away some of the real negatives that are attached to standard mutual funds, and they make them a lot easier to buy and sell on top of that. And the third thing that really kind of boggled my mind, because when I looked at Schwab on my Better Investing tool, looked at the data, Schwab looked like a bank. It was reporting like a bank, and I never had anticipated that a brokerage house had that much in common with a bank, although I did know that they held funds in brokerage accounts and they could transfer those funds to accounts that paid a better interest, etc. But Charles Schwab has over $200 billion held in actual bank deposits, making it one of the largest banks in the country. So those 3 things, the fact that it's as large as it really is, $3 trillion in assets, that it has a huge presence in the ETF business, and that it's also one of the largest banks in the country, are things that I didn't know about this company. You can see that the number of accounts has reached an all-time high at Schwab, as well as the amount of trading going on at the brokerage firm, both of them going up 77% in the last 10 years. That's a pretty healthy growth number. Next slide, Mark. There we go. I really, well, the right hand, I'm sorry, the left hand slide is kind of boilerplate. It's the kind of thing you would expect a company to talk about. It's a lot of glittering generalities, but I really like the the right hand slide, part of the slide here. TOA stands for transfer of accounts, and those red numbers show you the ratio of transfers, or think of it as money flowing in and flowing out of the company. In the last fiscal year, in 2018, twice as much money flowed into Schwab through incoming accounts as flowed out with accounts leaving to go to other brokerage houses. So that value of 2 means that they're getting a heck of a lot more business in dollars and in people than you would ever expect to have happen. You can also see that the amount of dollars, that's the the length of the blue bar on the 3-year graph there, you can see that that's increasing as well. So Schwab is very competitive, and it's staying competitive. I'm reading the Morningstar report, and I often don't see somebody making such a huge deal of the extremely wide moat and the extremely high level of stewardship that the company is garnering through what it's doing. If you're interested in this company, besides looking on that page, the web page for the company, I would urge you to read the Morningstar report. It's long, it's detailed, but boy, does it tell you a lot of things that you probably didn't know about the company. Next slide, Mark. There's lots of ways to average there, and they call themselves an asset gathering machine. And notice how fast that $3 trillion in assets, actually Schwab is claiming it's 3.4 trillion. They've taken it to a decimal place, and it's compounding at about 11%, and that still only represents about 7% of the total market that they have available to them. Look at the different businesses that make up this company right there, and you'll see that Schwab is taking a pretty good bite out of a lot of the different businesses. Next slide. Here's the lines, and if you've been using the SSG Plus, you know that there's a fourth line you can add to any company that reports to the SEC the way that a bank reports. And that would be all the banks, all of the insurance companies, and many of the brokerage houses. These asset-based companies, you can slap a line under your graph called total assets. That's that aqua-colored line right beneath the green one right there. And what you'd like to see is that asset base growing as quickly as their sales or as their earnings. In other words, up, straight, and parallel still holds pretty true, even when you're looking at assets instead of sales. And since Schwab is a bank and all these other things, it is classified as an asset-based company. Next slide. I used judgments of 9% growth in the asset base or the sales growth. I hold them to be proxies for each other. I decided earnings to grow about 8%, with PEs somewhere between 22 and 14, or an average PE of about 18. I'm telling you, this is an extremely conservative set of numbers, and yet it gives me return numbers that are somewhere between 12.5% and 16.5%. I think Schwab has an excellent chance of outperforming the market in the next 5 years. I'm holding it to extremely low numbers compared to what it has done in the past, and I'm still getting very good returns coming from this extremely large company. Remember, we expect a large company to grow somewhere in the 5 to 7% range, and when I can get a return of 12.5 to 16.5 out of a $3 trillion company, asset-based company, I'm pretty happy with that kind of return. Next slide. And I'm not by myself. Manifest seems to feel that 17% par is not out of range. I think Cy is going to take quite a bit of time and explain to you where the Manifest 17 comes from. And just pulling up the upper left-hand corner of the value line sheet, value line seems to suggest that somewhere between 10 and 23% is a good place for this appreciation to move, and that's certainly in the same ballpark that my study has. I also like the little mini industry study that I can do just by looking at the manifest sheet for Schwab, and it tells me that Schwab is the second on the list. The one above it is TD Ameritrade. The one below it is Raymond James. And if you're in an investment club that does industry studies, that tries to look at a stock and a couple of competitors, I think you're looking at a wonderful industry study here. My investment club, B.I. Baker Model Investment Club, just about 2 weeks ago, studied this industry and came to the conclusion that we really wouldn't mind owning any one of these three very strong brokerage houses, and all of them having roughly the same potential return moving out, all of them having seemingly the same or roughly the same par values as well as quality values. Very high quality for all three of them, 85, 87, 96, which in my mind is pretty close to the same number. That fourth one is Goldman Sachs, another really high quality company, not quite as much par. And I wouldn't even consider the last one on the list, which I don't even know what it is, BGCP. Anybody know what that one is, Mark or Cy?
I do, but in the interest of time, I'm forgetting.
Okay, good. Then let's go to the next slide.
I think that's your last slide. Yep.
Right, it is. So I think what we want to do then is we want to go to Cy's first slide then and let him fill you in on some more ideas about Schwab. And the two of us are going to lobby you to give us your vote so we could put 4 positions into the portfolio for Schwab.
All right.
Yeah,
thanks.
no collusion here. No collusion.
None at all. We arrived at it completely independently.
Okay.
Ken's given you a good overview of the company. So what I was going to concentrate on was how I came up with my pick without collusion. And I'm actually not going to talk about the manifest analysis of Schwab specifically, though I will compare it a little bit to mine and to Ken's. I will use some of the manifest tools in helping show how I arrived at it and decided to pick it. First of all, I started where I usually start every month, is take a look at the current roundtable portfolio, rank it by par. I decided this particular month I wasn't interested in anything in the yellow range, given where the market is right now. And actually, in this particular portfolio, with the exception of Biogen and Facebook, I probably would exclude those yellow stocks based on the combination of being yellow and not excellent quality. In fact, only 2 are even good quality companies other than Facebook and Biogen there at the bottom. ADS also has had a few problems, so I kind of excluded that, as well as the fact that it's been, I didn't want to get in a war over our relative return-based experiment selling and buying back and so forth, so I didn't do that. 2.6 has appeared on some screens of mine, and I've been looking at it a little bit. But again, the financial strength that I've circled gave me a little bit of pause, given the market right now, which then left me with Schwab. Schwab is a 2-time selection. I'm almost guessing that it may even be a 1-time with an audience second, but I don't recall when it was picked, so I don't know that for sure. But that was a reinforcing reason, the fact that it's a relatively infrequently picked, with just two picks in the portfolio. Next slide. So then I did what I, again, normally do. Ken gave you the quick summary off the Schwab page. I actually go to the industry page, which in Schwab's case is capital markets, gives you just a little bit more detail than what Ken was showing on his last slide. You see that Schwab is the 3rd highest return, again, the highest sweet spot non-yellow company, also the highest excellent quality company with a sweet spot return. So I usually rank by par when I do this industry study, but I also like to rank by quality, which I've done in the next slide to compare. And here again, you see Schwab comes in excellent quality. Again, TD Ameritrade, Raymond James would all be good picks by this criteria. They all financial strength are comparable, and even their yields are relatively close. Though Schwab comes in a little bit below those. So really, all 3 of those companies, based solely on the manifest numbers, are very hard to distinguish. They're all very good, solid high quality companies, and notice even getting over into the growth column. They're all comparable in the growth, Schwab having a slight advantage there. So for all of those reasons, I decided that I would stick with Schwab since it was still in the portfolio, and on balance, it is just slightly better in return and growth than TD Ameritrade and Raymond James. Next slide. I started to use the Eagle from Manifest that I often use in going through the judgments, but I decided to use my personal SSG simply because I did the analysis based on revenues as opposed to book value, and so the crossing between the two would not have been quite as smooth as I wanted it to be. So just to keep things uncomplicated, I figured I would go ahead and give a revenue-based analysis, but then as I went through it, discuss how it compares to the book value-based Manifest analysis. Here you could see that revenues have grown at roughly 10%, and I chose to go ahead and continue that 10% growth. That's slightly above Ken's 9% that he selected. Next slide. Then I chose to use the 5-year average pre-tax profit and reduced that to come up with a net profit figure using the last year income tax rate. Quite frankly, I don't know where income taxes are going to fall for Schwab because of the Tax Act. We've discussed that quite a bit, and I know Ken and Mark have gone into even some more detail in various discussions about the uncertainties introduced by that, but I figured the 26% roughly from 2018 was a reasonable number, and that gave me a net profit relatively comparable to that used by Manifest. Then I went in and I used essentially the 10-year median high PE and went ahead and plugged in a low PE based on roughly the low PE in the last 5 years, which interestingly enough, although it's not what I was shooting for, gave me an average PE of 24, which is exactly what Manifest uses. So we ended up with relatively close earnings per share. Manifest, I believe, has 369 as earnings per share. You can see my revenue-based calculation came up a little below that at 331 a share. We used the same PE ratio. I came up with a 14.5 projected average return using the average PE comparable to Manifest, which is between Ken's figure of 12.5, I believe, pretty close to that. Yes, 12.4, and then the Manifest 17 that Ken showed earlier. I believe at today's close it's 16.6. So again, I second Ken's recommendation that we add Charles Schwab to the portfolio, or accumulate another Charles Schwab.
Okay, well, thanks, guys. Yeah, and working in the field that I do, Charles Schwab is very respected and used by investment advisors, as well as Ameritrade. I think they both stack up very well and are very, very responsive and favorably received by that segment of the marketplace. So they're both in pretty good shape.
Yeah, I guess in full disclosure, I should acknowledge that I helped contribute to Schwab's revenues.
There you go. Good stuff. All right, thanks, guys. All right, quick public service announcement. On the heels of Cy and I both colluded last month to select CVS jointly, and one of the things that we did point out is we were in the process of looking for pro forma and a little bit more information the big picture here, the nutshell that I would give to you is that, wow, that company is attempting to change dramatically. And probably I was somewhat aware, but not aware until Cy brought it to our attention last month. I mean, you're basically talking about a company that's ripping out half of the junk food and replacing it with healthy food and more physician's assistants and nurse practitioners and therapists and who knows what. Basically taking the clinic concept and growing it out and becoming a total health solution. You can take a look. We've actually put together a report at Manifest Investing, but this is our Slipstream blog where we give you kind of like appetizers of some of the stuff we've been doing. If you go to expectingalpha.com, even if you're not a Manifest subscriber, you can see this basic report on a dramatically changing company that probably changing more dramatically than I even gave it credit for. Any thoughts on that, Cy?
I thought the article is excellent, and you have just summarized very well kind of the vision that CVS Health has for itself as being a total healthcare company. And it's interesting. I almost wonder if it was in the back of somebody's head, somebody's mind, that they were going to seek to acquire an insurer, or perhaps they just came about it inadvertently and coincidentally. But I'm thinking back to what was it, 4 or 5 years ago, when CVS took cigarettes out of their retail stores.
Yes, I remember it well.
And it's when they were really emphasizing the minute clinics, the nurse practitioners being placed in the stores, and part of the rationale at that time was that we are trying to become a total healthcare company, and it's inconsistent to have something that is detrimental to health in the form of cigarettes when we're trying to be a total healthcare company. So the language of this total healthcare company and this vision that they have really far predates the Aetna merger.
Yep.
And acquisition. So I just tossed that out.
Yep. Good stuff. So if you go to expectingalpha.com, you can actually click on the article to go there. I'm going to talk in a few minutes about this 10-year thing, and that's also going to be available there if you want to take a deeper look at it. Much like Cy, I typically will do various different flavors of stock searches, and you can see that tonight I basically went looking for a company that had excellent quality of 80 or above. I do want B++ or better type financial strength, so you see 70 here. We're looking for double-digit growth most of the time. It doesn't mean we won't settle for a little bit less than that, but we do want to keep those numbers up, so you can see the 10% as one of the search criteria. I also, in the spirit of Hugh McManus and his desire to be buying companies when they are valued fairly close to their 52-week low, I went searching for companies that are within 20% of their 52-week low, and filtered the list down for that. And then I always, when I'm doing this type of a search, will quite often use the Manifest rank, which is it's a combined factor that looks at the return forecast in combination with the quality rating on a company, and basically treats the two as equally weighted but very important characteristics. So we're looking at the top percentile of the 2,400 companies that meet these screening criteria. So here's the list that you can see, and you've already heard many of these mentioned a few times. Alliance Data going through some pretty stiff challenges right now. Couple decisions haven't worked out very well for them, so kind of letting things work out there and see what goes on. Going to come back to Booking. That's the one that I will be selecting for mine. You can see the numbers are very high quality and probably in the buy zone of most stock studies. Proto Labs is in the middle of an update that will take it down just a few percentage points. Great company, still a great company. It's kind of a community favorite around here. But a little bit weaker than expected. Cognizant, pretty good study right now, but we've selected it 15 times, and I didn't want to dilute size contribution to all of this. You can see that a TD Ameritrade makes the list down at the bottom. Again, as Ken was urging, an industry study which would include TD Ameritrade with Schwab and perhaps a couple other competitors is a good idea. And Cantel Medical, a company I don't know a whole bunch about, but who knows? Maybe they'll be acquired by CVS one of these days. Probably a pretty decent study. I do know that it's been a Tom Gardner, Motley Fool favorite for the better part of 10, maybe even 15 years. So all of those things are pretty good. So I'm going to go with Booking tonight because of the decent growth expectations in the low teens, fairly moderate PE ratios. Pretty interesting company with very good balance sheet, very, very solid financial strength, pretty durable results, and just pretty good results across the board. You can see up straight and parallel is kind of a way of life at this Bill Shatner company. You've seen the ads for years, but these guys are a dominant player in the leisure booking industry. One of the reasons that I'm drawn here is, this is another one that you can find at Expecting Alpha. You can see the address at the bottom of the page there. We put out a report on the top performing companies over the last 10 years since the trenches of the Great Recession back in March 2009. And these are the companies that have performed the best over that time frame. And as you kind of delve down that industry list, looking at, interesting things, first of all, you see a number of broadcasting TV. We're going to be looking at that a little bit closer, but kind of the common thing that kind of resonates with this list is there's a whole bunch of leisure and entertainment and personal health care and vanity type stuff that never seems to go out of style. And you can see that there are a number of companies that have been featured prominently here at the roundtable and certainly at Manifest Investing. Jazz Pharmaceuticals is in the 10-cup portfolio. So again, there's just this theme of leisure and entertainment. It's a pretty good idea over the long term when you can find them an excellent company in that business on sale. You can see that Ken's Las Vegas Sands is on here. He featured years ago at the round table. So kind of a fun list. The top, I believe, top 100 is actually listed at that article. You can kind of go down that list and look at these returns. That's annualized over 10 years, guys. So we like to see those companies showing up in the Groundhog portfolios and in many of your portfolios out there. Here's a look at Booking over the last 10 years. And you can see that it definitely has its fits and starts and speed bumps, and it's in the middle of one of those right now. Even though the fundamentals of the company continue to be strong and improving, it's in one of those moments where you can see a slight plateauing or a slope down at the far right-hand side on those monthly price bars. It's actually reached the point where the loss over the last calendar year is about minus 15%. With the fundamentals improving, these long type of flat spots can be very valuable fields of opportunity. I think of examples of companies like Home Depot. If you actually look carefully back at a 30-year perspective on Home Depot, you'll find a number of plateaus where patience would be tested. I mean, here's one right here with this company that lasted a number of years, that flat spot. Meanwhile, the business is improving and improving and improving. And in the case of Home Depot, investors would get tired and begin selling it off, just extending the flat spot. And eventually it would just take off and do the types of things that you see here on a number of occasions. So the relative strength index, that's not the same as relative return. This is kind of a technical analysis thing, but still is good to see that it's down in the more towards oversold than overbought. So some good long-term thinking as long as the business stays intact and keeps marching forward. Here's the closing paragraph from the most recent value line from earlier in the month. Again, they see a fairly solid business that is continuing to grow across all kinds of dimensions and grow profitably. You're familiar with the Booking.com and the Priceline aspects. Kayak, again, is a very cross-functional search for entertainment and leisure reservations and that type of thing. You see rental cars. And then they also acquired Open Table, which is a fairly innovative seating and host station management for restaurants the last few years. So again, they're trying to cover a lot of bases, and they're doing it pretty well. As it says, they're a world leader in online travel and related services, and we know them very well as Priceline. Closer look at the company, again, up straight and parallel, a company growing in the low teens. Let's focus in on this second column here for right now. We basically have a $15 billion company that's growing at about 14%. Again, that is the slope of that red line. Projected net margins in the 30% range. Again, it's fairly easy to make the case when you look at the performance down at the bottom and the projections that this company could make 30% net margins. It has in the past, and all indications are pretty good. The PE is remarkably consistent for a company like this. You can see that the PE, projected PE out in the 3 to 5 year time frame is 20, and it's been remarkably consistent. So again, a company of this size growing at 14% with steady profit margins, very nice PE ratio expectations for the future. You're talking about, again, a 15% projected annual return, and this is just simply proof that Value Line sometimes is troubled or challenged by what is still a relatively new company. For purposes of a year-to-year comparison, you can compare the two columns and see that things are holding in there pretty good. But I would say from front to back, considering the things that they do and the role that leisure, entertainment, and those type of companies play in our lives, a lot of baby boomers out there that are willing to do these type of things. Every time we turn around, I see that Cy or Ken and their spouses are traveling somewhere. So I think there's a rich field of opportunity for a company that has demonstrated that it knows what it's doing.
So and we use Open Table a fair bit when we travel, Mark, so you'll be happy.
Celebrating more cardinal losses, apparently. All right, so we're going to go ahead and add booking. That's been a multiple selection, so it's a repeat selection for the roundtable. So with that, Ken, I think we'll go ahead and switch to the poll if you're ready.
Can you hear me, Mark?
I can. You're back.
Okay, the poll is up, ready to go. So all you need to do, folks, is to choose one of the two right here. And I'll leave it open till we get maybe 80, 85, 90% of the folks voting. We're up to 70% voting. So even if you're new, play along and choose one of the two companies, or choose none of the above if you don't like either one of them. We're up to 81%. Let's give it about 10 more seconds. Come on, can I coax a few more people to vote? There we go. We're pushing it up to 90 now.
I figured out with the new panels I can actually watch. We didn't used to be able to do this.
Okay. I'm going to close the poll, and I'm going to share the results. And it was a pretty close race this evening, 53-44, 53% for Schwab, 44% for booking. So because two of us chose Schwab, we'll put 4 positions into the tracking portfolio for Schwab this time. And let's see if I can hide that now and go back to the next slide then, Mark.
Okay. And I want to thank those of you who voted for the lonely combatant in the cage match tonight, double teamed by the other two. I feel like I held my own fairly well against the two of them.
Wow.
It was pretty much all right, Ken, you want to take us through what we're doing for this year's?
Yeah, Mark and Cy and myself will be all over the country in the next 3 or 4 months, and you can see right here what's going on. The first 3 are our local programs, 2 Money Smart Week programs up in the mid-Michigan area, one in Bridgeport, one in Grand Blanc. So if you're around and would like to come to a Money Smart Week program, there's 2 programs going on. We're co-sponsoring a program with the Southeastern Michigan chapter down at Flint Baker College on April 13th, and Mark will be there to give the keynote. And I'll be there to teach a class along with some of our directors, and we'll be looking at some portfolios during that particular class. We're back online with investing topics, the war on your stock studies. That's meant to invoke a little bit of curiosity, at the same time a little bit of thought about what's happening with your stock studies, and are you getting the full skivvy on what you should be looking at when you put a stock study together. It'll be an interesting presentation, I'm sure. Yeah, our next roundtable a month from now on April 30th. Go on, Mark.
I was just going to say, the work on your stock studies, I think it kind of takes me back to where we were 10 years ago when the Great Recession was doing a lot of damage to our stock selection guides and that sort of thing. And just to frame it in terms of that the audience can relate to, I remember Ralph Seeger once said that variations in shares outstanding brings our analysis method to its knees sometimes. If you think about what's going on with buybacks and profitability shifts and, you know, the trend damage done to some of these companies, things that Warren Buffett has said about the tax law changes and the effect on reporting at companies like Berkshire and whatever, just the shifting profitability trends and all that kind of stuff, I think we could have a pretty nice session of, you know, how do we deal with some of this stuff, the buybacks being a kind of a central piece of it all. So come and check it out. We'll put out a little bit more information on what we hope to cover and how do we get the most out of our stock studies. Thanks, Ken.
We'll be happy to meet all of you in Pittsburgh on May 4th. The convention is in Chicago this year, May 16th through 19th. Mark and I are up in Traverse City on June 1st. We're in Oklahoma City on August 17th. And then Cy and myself and Kim Butcher will be in Atlanta on August 24th. So if you get a chance to come and say hi to us at any one of these events, you'll certainly learn something at any one of these that you pick. And especially we'd like to invite you to our 2 online programs, the Investing Topics program and the Investors Roundtable program. So come join us again. We're so happy you were with us this evening. I'm going to try to clear out some questions now, Mark. I don't know if you want to keep the recording going or not. I'll leave it up to you.
I think we'll shift gears and say thanks, everybody. We'll stay online and do a little bit of open Q&A. But, again, thanks for coming, and we look forward to seeing you again soon. Thanks, everybody.